Good afternoon, children. As a part of BA second year semester 4 in economics subject, we have public finance and international economics, in which we are dealing with different topics. In the earlier classes, we were discussed about nature of the public finance, scope of the public finance, principles of public finance, maximum social advantage, sources of public revenue, classification of public revenue and its sources, canons of taxation, its impact, canons of taxation, its incidence, taxation effects were discussed in the first class in the earlier, that is on 26th of this month, during the same time, that is 7 to 8. Then next, in the yesterday's class, we were taken up topic about public expenditure classification, public expenditure principles, public expenditure determinants, public expenditure effects. In addition to that, we were also discussed about the public debt, that is nature of the public debt, difference between private debt and public debt, difference between internal debt and external debt, sources of public debt, classification of public debt, effects of public debt, and how we can repay the public debt, that is redemption of the public debt. These were covered in the earlier classes. As we have a basic knowledge about now public revenue, public expenditure, public debt, now we can move on to the new topic in connection with the same, that is fiscal policy. Generally, we used to listen, fiscal policy means nothing but it is taxation. No. The public finance consists of public revenue receipts, capital receipts, public expenditure, public debt. All these are a part of public finance, that is fiscal policy. Our fiscal policy is different from other countries because during the normal conditions, our country perform its function like a federal. During the emergency period only, it will become unitary. That is the characteristic feature of our Indian Constitution. So, our federal finance, how it is, that when federal word is used by us means the distribution of economic power, collection of receipts and expenditure by the central and state governments. So here we are also going to cover about the budget. So for that, we should know fiscal policy and federal finance. that now we are going to deal. So this is important. You should get clarity over all these concepts, especially budget concept, budget types, budgeting, especially in India. As you are aware, budget in India coming to the force from 1st April to 31st March, which period we call it as a financial year, budget year, accounting year. Dear children, fiscal policy denotes the use of budgetary instruments for advancement of socio-economic goals of our nation. We will come to know the concept of fiscal policy, objectives of fiscal policy, especially in the developing economies, and how center state financial relations. What is finance commission? What are the functions of the finance commission? In addition to that, various concepts, components of the budget we are going to deal now. Dear children, fiscal policy refers to policy of the government with regard to taxation, public expenditure, public debt. So public finance consists of revenue receipt, capital receipt, plan expenditure, non-plan expenditure, developmental expenditure, non-developmental expenditure, capital expenditure, revenue expenditure, public debt, that is internal and external borrowing. Of course, taxation is a part of revenue receipt. All these together only we call it as a fiscal policy. In a nutshell, fiscal policy is the policy of the government with regard to the taxation, spending, borrowing in an economy. Different economists given different way their definition for this fiscal policy. Arthur Smith defines that fiscal policy is the policy under which government uses its expenditure and revenue program to produce desirable effects and to avoid undesirable effects on the national income, production, and employment. Whereas Wolfson aptly he describes that fiscal policy comprising increase of the general welfare of the public by controlling the resource especially public spending, resource mobilization, and to run public sector units, enterprises. Here I want to make it clear, my dear children, there is a difference between fiscal policy and monetary policy. Monetary policy is generally under the control of central bank of that country. Example, this monetary policy, instruments, policy, etc. will be regulated by Reserve Bank of India. In that monetary policy, we speak about quantity of money, supply of money, circulation of money, etc. Whereas the fiscal policy is different. That is under the control of the government for the welfare of the nation, which consists of taxation, expenditure, public borrowing. My dear children, the fiscal policy according to classicals, it is decided by the market forces of the demand and supply to achieve full employment, maximum utilization of resources, and for the interest of the nation. In fact, the classical economists not advocated the government intervention. As you are aware, 19th century onwards only, government intervention started in almost all economic activities. Earlier, it was limited to law and order, but now government acting as a producer, distributor, investor, entrepreneur, it is not only performing the consumption duty, all other economic activities also shared by the government for the welfare of the nation. That what we come to know from earlier topics. So the modern concept of fiscal policy is different from the classicals. The modern fiscal policy is a technique to maintain full employment through the public expenditure that is done by the government to achieve equilibrium between aggregate demand and aggregate supply, which was advocated by Lord John Maynard Keynes in his general theory in 1936. To achieve the effective demand and to avoid the economic fluctuations or economic crisis. So the classical view is different on fiscal policy, and modern economists Keynes version is different on fiscal policy. Right. What are the objectives of this fiscal policy? Not PHY beta. It is FISCAL, fiscal policy. This fiscal policy is a different one nation to other nation. This full employment, stabilization of economic fluctuations, achieving the growth, to achieve that only our fiscal policy. Especially in the developing nations is different from developed countries. The developed countries' objective is different. They want full employment, control on inflation and deflation, maintaining the economic stability, price stability, and acceleration of economic growth. These are the objectives and aims of the developed nations, whereas this fiscal policy in our developing countries is different. Our objective, especially in the developing countries, increasing the employment opportunities. We are not speaking about the full employment, but employment opportunity is supposed to be increased through the fiscal policy. Mobilization of the resources, proper allocation, fuller utilization, optimum utilization, curtailing the wastage of resources, mobilizing wherever we require. That is also a part of our developing countries' objective of the fiscal policy. And not only that, to bring economic equality among the all, that is to decrease the gulf gap between rich and poor. That is also one of the objective of the our fiscal policy. In addition to that, we also want economic growth. These are the objectives of the developing countries. Now, let us come to know about the federal finance. Ours is federal country, no? So here, the federal finance, the relationship between state and central government, because central will collect different way and central and state spends different way. Here dual government is there, no? Central and state government. That's why oftenly there is a clash between central government and state government, isn't it? And we used to blame that center is following the discrimination among the one country, one state to another state. Especially in India, we used to tell most of the funds are allocated to the only so and so states and not for our states like that. So that is there. So here, the distribution of power, especially economic power, but supremacy is the center, not the state. And court also may intervene if properly not distributed or properly not spent or properly not collected. But that one doctrine or one policy or one principle we follow, that harmonious way the distribution is supposed to be, not in the harmful way. Moreover, it is constructive, not for the destruction. Especially, the federal finance supposed to be efficient way. The federal finance supposed to be uniformity. It should not be in the different way. Children, here the principle of federal finance is efficiency. Second is uniformity. Union government should perform responsible that all the state government equally they should get treatment in respecting granting aid, sharing the tax burden, benefits to provided to them. Otherwise, one state will be high burden on the tax. Some other state get more grant in it. So that's why we should follow uniformity in the federal finance. Economy. The central state supposed to judiciously, I mean, thrifty way, that is less expensive way, more allocation and more spending for the more development it's supposed to be. And autonomy should be given to the states to spend. And now and then, if it is intervening, they cannot able to collect the revenue and they cannot go for the proper spending also. Unnecessary intervention of the central government in the local government, not good. If it is required, we can go for. So here, self-sufficiency. State supposed to generate its own revenue receipts, and it's supposed to spending means no burden, no problem, no need of depending on the Santa. But unfortunate thing, due to the GST, that is goods and services tax, most of the states are completely become a parasites, are dependent with the central government. Sometimes they delay in allocating, sometimes they may go for discrimination also, but it should not be. And this federal finance supposed to be flexible, not it's supposed to be rigid. According to the requirement of the state, we supposed to go for. And economic regulations also required. Transfer of resource is also one of the principle in the federal finance. So these are the principles to be followed in the federal finance. And one more thing we supposed to know about the center state financial relations. We have three lists in our constitution. Especially we are following parliamentary type of democracy, indirect democracy. Government is by the people, for the people, to the people, of the people, according to definition of Abraham Lincoln, former president of America. So in our government, we follow the principles of constitution, and to maintain or to regulate or to follow or to rule, we have three lists for preparing the law or executing the law into force. Those are called three lists: union list, state list, and concurrent list. The powers are distributed like that. In that way, the financial relations also will be there. As per constitutional division, union taxes laid by list 1 of the 7 schedule as follows. Income tax on non-agriculture income. The tax will be levied by central government. Corporation tax also levied by central government and collected by central government. Excise duties on tobacco and other goods manufactured in India except alcohol. Estate duty on non-agriculture lands Taxes on capital values, taxes other than stamp duties, that is stock exchange, future markets. Rates of stamp duty, bills of exchange, checks, promissory notes, bills of lending. All these are in the central list, beta. That is union list. Taxes on sale and purchase of newspapers, advertisement. This is also part of union list. That is central government. Terminal taxes on goods, terminal taxes on passengers carried by railway, waterway, that is sea, airways, taxes on railway passenger fares and freights. That is also union list. That is central government. Taxes on sale and purchase of goods other than newspaper also. Purchase of. Now, another one, that is taxes on consignment of goods, interstate trade conference, state trade and commerce. Another one, customs duty, export import. This is also in the union list, that is central government only will collect it. When come to the state government, that is state list, this is in the jurisdiction of state governments only. Land revenue, of course, in Telangana, no land tax. If any state is there, that is a part of state list. During N.T. Ramarao, when he was a chief minister of Andhra Pradesh, he only removed this land tax, land revenue, and not collecting any tax from the land, cultivable or non-cultivable, or cultivating or non-cultivating lands also, that you know very well. Taxes on sale and purchase of goods, excluding newspaper. So other sales purchase tax, that is we call it as sale tax now. Agriculture income tax, taxes on property, property tax for a house tax we are paying, no? Building tax we are paying, no? That is collected by state only, imposed by state only. Estate duty, especially in the agriculture land, not on the non-agriculture lands. Excise duties on the good containing especially alcohol. That's why we used to see not different rates in the different states, especially in the wine, isn't it? So alcoholic liquors, all these, even opium, hemp, narcotic drugs, narcotics, all these are imposed and collected by the state only. Taxes on entry goods into the local area. Here and there, they used to collect now, not the toll tax, other tax also on the road, they used to collect. You might be known. Then tax on the mineral right. When we are extracting or exploring or sending or sailing on those minerals, maybe iron or bauxite or gold or diamonds or anything which you are extracting from the beneath of the earth, on those that we suppose they who are trying, they are supposed to pay tax to the state government. Taxes on consumption, sale of electricity. Of course, earlier Congress government during the Y.S. Rajashekar Reddy, they only removed the electricity charges, especially for the farmers, free electricity. Right? Then next is taxes on animals, boats, vehicles. That is also collected by the state government. Stamp duty, terminal taxes, taxes on luxuries, amusement, betting, gambling, toll tax, taxes on profession, taxes on trade, taxes on employment, taxes on callings, taxes on capitation, taxes on advertisement, etc. All these are levied and collected by the state governments. You may ask one question. Because of the GST, all these are amalgamated and made it as a state GST, central GST, no? Yes. But we have a such type of provisions according to our rights, that is state list. Then concurrent, that center also can impose and collect. State also can impose and collect. But when both are introduced, the central one only final. The concurrent list includes subject that gives power to the government, subjects like education, technical education, medical education, universities, population control, family planning, criminal law, prevention of cruelty to animals, protection of wildlife. The law is passed by parliament or state legislature. If it is the both are passed the law, the parliament one only the final. Okay, the administration of justice, weights, measurement are transferred to the concurrent list. In addition to these sources, revenue, constitution provided granting aid to the state. The grants are given by center. For that, what is the basis? Population. Second is area. Third is the income generated from that state. But who is following? When center state conflict is there, different parties are ruling according to their will and wish, according to their mercy, all states are depending on it. That's why always there was a conflict. Okay, that is different. Let us come to know one of the important thing, that is about the public policy or finance making. One institution is constituted, which we call it as a finance commission. According to constitution only, it is established under Article 290 of the Indian Constitution. It is constituted in 1951 to make good financial relationship between center and state. It aims to reduce clashes between center and state, to bring balance and to promote social justice, economic welfare of the country. Public finance set up for every 5 years. It will recommend different aspects to the governments. Those are valid one, and government supposed to follow it. Recent, the 14th Finance Commission set up in 2013, which was valid up to 2020. 15th Finance Commission set up in 2017. Its recommendation already started implementing 2020. The 15th Finance Commission, chaired by Nand Kumar Singh, Arvind Mehta, will be the secretary to the commission. Other members are former economic affairs, that is Shaktikanta Das, and former RBI governors, etc. will be there. Advisors will be there, and Niti Ayog member will be there. I forgot to tell you here. Earlier we have a planning commission that was removed during this BJP government, replaced with Niti Ayog. The Finance Commission functions are setting up rules regarding the distribution of tax revenue between center and state. Are we following? That is a big question mark. Next, determining the principles governing the allocation of granting aid, states and local bodies. Yes, it will determine. But are we following? That is different. Determining granting aid allocate to the state, that will also be question mark sometimes. So, but it will recommend and I be supposed to follow it. So, my dear children, we could come to know various aspects under this topic. One more thing to be covered today in this present class, that is about the budget. What is budget? Budget concepts, budget types, budgeting in India. The main objective of this topic, we will come to know the meaning, concept, objective, classification, types, revenue account, capital account, budget deficits, budgeting in India. We are able to know all these. Budget is actually derived from English word bogette. Of course, it is originating from French word bogette, that is a leather bag. India first budget was presented in on 7th April 1860 when we were under the British colonial rule. That time finance minister was James Wilson. What is the meaning of budget? Budget is a financial statement of estimated receipts and expenditure of the government for a financial year. Once again, I want to repeat for the benefit of you, very small and one sentence only. Budget is a financial statement of estimated receipts and expenditure of the government for the financial year. Very simple. Estimated and anticipated, expected receipts. In the forthcoming year, what we are going to get income or receipts, and for what purpose we are going to spend on which one, that we will. This is estimation only. If your financial year, that is in India, 1st April to 31st March. It is prepared by Budget Division, the Department of Economic Affairs. Of course, it includes revenue, expenditure, liability, borrowing, etc. In summary, what we want intended to spend on for what purpose, that we will come to know through the budget. Budget only now we come to know what is the slab rates for the income tax, how it is going to change. In the budget allocation, railway lines came or not, roads came or not, how much fund allocated for the plan way, non-plan way, and for the different states, all these will come to know. Yes. Now, what some of the concepts we should know from the budget, my dear children. Receipts. Receipts matlab, that is income source for the government. Receipts collected by the government through revenue receipt and capital receipt. What is revenue receipt? Very simple. Revenue receipt not create liability, not reduce the government asset. In that, good example is taxes and non-taxes. In the taxes, we have again two: direct tax, that is income tax, corporation tax, wealth tax, gift tax, property tax, etc., which you cannot shift to the others. Indirect tax, that is excise duty, custom duty, service tax, sales tax, all these are the indirect tax which you can shift to the others. Non-tax revenue, that is, we know, that is fees, fine, forfeitures, etc., penalty, all these. My dear children, this is about the revenue receipt. Then what are the capital receipts? Capital receipts, either it reduces the asset or increase the liability. When it increase the liability means we are borrowing. Reduce the assets means selling of public sector units. Nirmala Sitharaman, she is ready for selling the steel plant in Andhra Pradesh, that you know well now. That is demonetization, also one of the instrument. Not only that, disinvestment, isn't it? Withdrawing the investments by government. In that way, our assets will reduce. So in that way, we may get some amount that is capital receipt, but it is not good for any economy. Recovery of loans, capital receipt. Borrowings also capital receipt. Disinvestment also capital receipt. Denationalization also gives capital receipts. So whichever the capital or revenue receipt which we received as an income to the government, we go for spending for the welfare of the people. So here receipts, how we are classified, the expenditure also can classify, that is revenue expenditure and the capital expenditure. For example, road maintenance, revenue expenditure, it is not going to create any asset or reduce in the liability. Whereas construction of roads and construction of buildings, construction of residential buildings, this is creating, this expenditure is creating asset. Sometimes we may repay our loans, that is reducing our liability. Such type is called capital expenditure. So revenue expenditure includes salaries, interest payment, pension, subsidies, etc. Capital expenditure is expenses on construction of roads, bridges, buildings, etc. Anyway, when expenditure is more than receipts, automatically we face deficit. That if both are equals, balanced. When it is receipts side is more, then it is surplus. But in fact, we are seeing only deficit. The deficits also three types: revenue deficit, physical deficit, and primary deficit. Different types. Revenue deficit means revenue expenditure is exceeding revenue receipt. Revenue expenditure is exceeding revenue receipt. Is another way. Revenue receipts are less, revenue expenditure is more. There's another deficit, my dear children, capital deficit. That is, capital expenditure is more than capital receipts more, but capital expenditure is more than capital receipts. The physical deficit, total expenditure is more than total receipts, excluding borrowing. So anyway, so any deficit budget is not good, but it is most of the countries are following the deficit budget only. Good example is India. Actually, what is the aim and what is the objective or what is the goal of our budget? First and foremost is redistribution of income, redistribution of wealth, redistribution of assets, leaving the tax more on rich, giving the subsidies to the poor people, like that. Reallocation of resources. If allocation is not proper way, we go for reallocation for the social welfare. Another objective is economic growth, acceleration of economic growth, increasing the saving, increasing the investment, increasing the capital formation, increasing the production and productivity. Another objective is economic stability, is to stop ups and downs, that is inflation or deflation. That is another objective of the budget. And managing the public sector enterprises. Maybe ONGC is there. Steel Authority of India Limited is there. Like that, Navaratna, Mini Ratna, Maharatna, all these are run by government only. For that, budget allocation will be there. That is managing the public sector enterprises. This is about the objectives of the budget. My dear children, the budget can be classified according to time, according to functions, according to flexibility. First, let me tell you, based on the time factor, long-term budget, short-term budget, current budget. Just for this short period, that is current budget, to meet out the temporary some months. For a year, that is short-term. For the more than 5 years, like that, long-term budget. That is one classification. Another classification according to function. Production budget, material budget, labor budget, factory budget, sales budget. This is based on the function. Administrative budget, selling and distribution budget, capital expenditure budget, cash budget, master budget. This is based on the functions. If it is about the administration, that is administration expense budget. If it is selling and distribution, that is overhead budget. If it is only for the capital expenditure, that is capital expenditure budget. If it is material related, that is material budget. If it is production related, the production budget, etc. That is based on its function, we can classify in that way. Another classification based on the flexibility. Fixed budget, flexible budget. Once decided, accordingly, if we go rigidly, that is fixed budget. And there is a changes inevitable if executes and implements, then it is flexible budget. These are the base classifying the budget on the basis of time factor, time on the basis of function, on the basis of flexibility. We know that there are different types of budget. Balance, expenditure, receipts equal, balance. Receipts are more, expenditure is less, surplus. But deficits, expenditure is more, receipts are less. Those are classified into three, That is, my dear children, that is revenue deficit, physical deficit, primary deficit, capital deficit. Based on that only, we will come to know what is the performance of the budget. Right. One thing I want to share, my dear children, in the revenue account, what comes? You know well. Revenue account includes revenue receipts, that is tax and non-taxes. Direct taxes, indirect taxes, fees, fine, provisions, all those are come under the revenue account. When it comes to the capital account, you know well, that capital receipts, disinvestment, profit from the public sector enterprises, recovery of loans, etc. But budget deficit is not good for any economy. Revenue deficit or fiscal deficit or primary deficit, it's supposed to be monitored. Before concluding today's topic, I would like to share about budgeting in India. In India, government financial year is 1st April to 31st March. Objective of our budget: allocation of resources, redistribution of resources, stabilization of economic activity, managing the public sector enterprises, generating the full employment, increasing the production productivity, and acceleration of economic growth. All these are the objectives of budget in India. The budget procedure in India is preparation of budget. First, they prepare the budget, that is Ministry of Finance starts. That is under the division of Department of Economic Affairs. It estimates the expenditure of the different ministries, departments, and the same way it estimates the receipts also. Estimate of the budget prepared, and as a first reading, it introduces by the finance minister, especially in the lower house, that is in the Lok Sabha, not in the Rajya Sabha. All economic laws or procedures are starts from the Lok Sabha because it is representative of the people, whereas Rajya Sabha is representative of state, that you know well. So introduces on that the presented by the finance minister in the Lok Sabha. He or she makes the budget Lok Sabha, the copy of the budget laid on the table in the Rajya Sabha also. The printed copy is distributed among the members of the parliament so that they will go through and they may raise their voice and they may question and they reveal their proposals and they may argue about the government proposals and demand for the more grants for the states, etc. It will be there. So in the first that reading they introduces, then second reading that is discussion, and the third the after discussion some amendments changes will be taken place, and the third reading the voting will be there. If majority of the people are voted, then that bill will be passed and it will send to the Rajya Sabha. There also it will be discussion will be there. That is also majority is there or not. It will be after 13 days. It will go to the President of India and he will put his signature. Then that it come into the force. The execution of budget once finance and appropriation bill is passed, execution of the budget starts. That is 1st April onwards. So budget, in fact, introduces in the parliament in the month of February only. Throughout the February and March, discussion, amendment, all this will go on. Okay. So revenue department of the finance entrusted to responsibility of the collection revenue. Secretary act as a chief accounting authority. And now and then the accounts will be audited by the Comptroller Auditor General of India, CAG, CAG report we used to tell now. And Parliament control over the finance. The finance bill and appropriate bill are presented, debated and passed. Parliament being a sovereign gives grants to the executive which makes the demand. These demands can be varieties like a demand for the grants, supplementary grants, additional grants, estimates of the expenditure, etc. will be there. The Lok Sabha has the power to assent or reject or any demand. To assent any demand subject to the reduction of the amount specified. Formerly, all demands were introduced by the finance minister. These demands are presented to the Rajya Sabha through general debate. Budget takes place. The Constitution provides Parliament to make grant for the meeting unexpected demand upon the nation resources, the magnitude indefinite character. The demand cannot be stated with details ordinarily given by the annual function financial statement. Vote on account budget for the temporary when election is there or untoward incidents are taking place, emergency situation is there, that time the government may for temporarily it introduces the vote on account. There the big proposals won't be there to meet out the routine works and maintenance that will be introduced as a vote on account. Vote on account is a just interim permission to spend money as against full budget, which is an elaborate financial statement expenditure is. Vote on account is a special provision given to the government to obtain the vote of parliament to withdraw money when the budget is new financial year is not released. Elections are underway. Caretaker government is there. Like that only they go for. According to Article 266 Constitution, mandatory for the government to seek approval from the parliament before raising any funds. The when you know this thing, we should know the history of our Indian budget. Independent India, the first finance minister, independent India, R.K. Shanmugam Chetty, R.K. Shanmugam Chetty, on November 26, 1947, he introduced the first union budget. Of course, that time the partition of India also taken place. In 1914 and 50, again, John Mathai presented the union budget. That is when India became a republic and announced the planning commission. Mathai budget also budget took into account in the princely state. India as unit in 1957. Kaldar presented the budget, is the great personality, great economist. The first Prime Minister, Pandit Jawaharlal Nehru, under his leadership, this finance commission was constituted and full budget also introduced. 59-61, 63-64 union budget, interim budget was presented by Morarji Desai. Morarji Desai presented the budget, include five annual budget plans also. After Morarji Desai resigned, Indira Gandhi, Mrs. Indira Gandhi, Iron Lady of India, who was Prime Minister, took over the portfolio of the Finance Minister. First woman present Indian budget in 1970-71. In 73-74, budget became a black budget because that time physical deficit was there. That time Pranab Mukherjee was the finance minister. He introduced. Of course, Rajiv Gandhi presented the budget in 87-89. After VP Singh quit from the VP Singh was finance minister, he quit and he made another party. That time Rajiv Gandhi himself introduced the one. He is only the person introduced the corporate tax in 87-88 budget. N.D. Tiwari, S.B. Chavan, Madhu Dandavate, Manmohan Singh, these people were presented in a beautiful way and they made a roadmap how to present the budget and all. Of course, the recently how the presentation is going on and Mrs. Nirmala Sitharaman, how she is presenting the budget that you know very well. Under the Narendra Modi government, union government presented the finance, that is especially Arun Jaitley. In 2017, he is the first person who merged railway budget and union budget, that is Arun Jaitley. And under him only disinvestment ministry also there. So in this way, different budgets were presented by different finance ministers in India. I hope you understood today's